And we start off with the S&P hitting a major milestone right at the close. For a moment, just a moment, ticking above 5,000 before ending the day just 2 points below. The index still finishing the day with a record close. The Dow did as well. The S&P setting, the Nasdaq, setting a fresh 2-year high. The S&P's strength comes on the back of rallies in the mega cap names: Nvidia, Meta, Eli Lilly, all up 25% or more so far this year. So now that we've hit this big round number, where do we go from here?
Higher, Mel. No, look, congratulations. I mean, for everybody bullish on the desk, everybody but me, that's an amazing run. But I'll say this. I took the math in college for at least a day, and, 5,000 divided by 250 of earnings, which you're not going to get, is still a 20 multiple. So then ratchet down earnings, which are probably closer to 225. And we're looking at a market that's probably trading close to 22.5 times, which historically is pretty expensive. Now, you could say, you know what, it's justified. The rest of the world's slowing down. The United States, you want to be there. You should pay up for the growth. You should pay up on the multiple. I'm not one of those people that believes that, though.
Well, first of all, I haven't been one of those people you're talking about who've been bullish on the desk. But when you think about just what's gone on here, I mean, we talked about the multiple expansion that we saw last year. We saw the concentration of the top names in the S&P 500, which really just blew out the multiple of the S&P 500. There's plenty of sectors, and you guys have identified them that trade at very cheap multiples. But here's the thing about that expected growth, and guys talking about, okay, if S&P earnings estimates for this year are probably too high. We had 3% GDP growth last year. The Fed told us they're expecting 1.5%, this year. So with that, you would assume that earnings for S&P 500 companies would come down at a time where we've seen the dollar rally. We've seen crude oil just rally, 7% or so on the week. So a lot of those inflationary pressures that may get aggravated by further geopolitical issues, that sort of things, further supply chain issues, it just seems like it's really not discounting a whole heck of a lot of headwinds that we might see in the not so distant future this year.
Isn't it all about rates, though? And the fact that we know that rates are going to come down, that we've probably seen.
Wait, do we know that, though? Because we knew that. We thought we knew that at 3.8% a few weeks ago, but I just looked there at 4.15 in the 10-year.